Okay, today I'm going to explain what is a relevant cost. So a relevant cost is a cost that differs between alternatives. The difference in cost between the two alternatives is known as differential cost, or this is also known as incremental cost. So I'm just going to explain the relevant cost by taking one example. For example, in a sale, in any company, the sale of the company in 1 year is $250,000, and the fixed cost other than a depreciation are 60,000. Now, with the other information available below, that the company asked to the manager that should he take a decision in buying the new machine, or they are good with the existing machine. So with a new machine, we can have some information that a new purchase price or the list price of a new machine is 95,000, and annual variable expenditure are $70,000, and expected life of that machine is 5 years. And old machinery, that original cost was $125,000, remaining book value is a 75,000. Disposal value now, that is 20,000. So disposal value means that today if you are going to sell that machines, you will get some money, maybe the scrap value or salvage value. So if today you're going to sell it, you will definitely get $20,000 because that you're going to buy a new machine. So annual variable expenditures are $110,000, and the remaining life of the new machine, old machine is 5 years as well. So now what I'm going to do, I'm just going to make one analysis. If for example, one manager is there and manager want to make some incorrect analysis, so how he will be able to see this? He will check like that old machine, if the value of the old machine is a $75,000. So let's say the value of the old machine, if I'm going to write it here, right? So value of old machine, right? So value of old machine is 75,000, right? Now, so what we recover, the value disposal. So disposal value means that by selling this machine, that you will be getting only $20,000, and the remaining amount, if we say, so that will be $55,000. So that be the loss to the company if they are going to buy a new machine and selling the old one, right? So that will be the loss to the company. But this is incorrect analysis, right? So this analysis is not right. So what is the right way to do this one? This is the proper way. The way that I'm just going to explain, I'm just going to make one format here in Microsoft Excel. So 5 years, let's say for 5 years, then just we are going to keep old machine. I have made one column, then buy new machine, and the difference between these two. So for the 5 years, I'm just going to calculate how much profit we will have for the 5 year if we keep old machine. So first of all, sale. So how much sale is there for the old machine if we have? So old machines that we are having here, the value of the old machine which is given here. But first of all, that we want to know how much is the sale of some product. So $250,000. This is for 1 year. So here that I'm just going to multiply the 250,000 multiply by 5. So that will be 125, right? So 12,50,000. So that will be the sale, and exactly the same sale will be if we buy the new one, and there will be no any difference at all. Now sale. Next is we have some variable cost. So variable cost is also available per year for the old machines. So variable cost here is So this is the annual variable expenditure. So 110,000, right? So 110,000 into 5 years. In 5 years that you have to pay the variable cost in the company. This is the big expenditure of the company. So that will be in the minus, right? So minus $550,000. So that will be the variable cost if we keep the old machines. If we buy old machine, again, variable expenditure that we have to write it here. So what are the variable expenditure available if we buy new machine? It's it's given like the $70,000 is the variable expenditure per annum. Multiply by 5 because the 5 year is the expected life of the new machine. So 7 into 5, 35. So $350,000 that we will write here. Yes, so there is a difference between these two. If you keep old machines, expenses are more. If you buy new machine, then expenses are less. So the difference between these two, that will be the saving in the expenditure. So saving in expenditure, that will be $200,000. And the next we are going to write here fixed cost. So what is the fixed cost in this case? The fixed cost that will remain the fixed whether that you keep old machine or you buy new machine. So what is the fixed cost here? So fixed cost is $60,000. So 60,000 and multiply by 5, that will be minus $300,000 here. If we keep old machine as well as exactly the same figure if you buy new one, and there is no difference at all. So that will be the sunk cost, if you can say. The next we have the depreciation expenditure. So depreciation for the old machine, definitely the old machine depreciation will be $75,000 because today value of the machine is 75 over a period of time after 5 years. So this expenditure will be set off as a depreciation. So here that is also one of the expenditure, 75,000. And if you're going to buy a new machine, also that you want the book value will be zero. If you want the book value will be zero, definitely the $75,000 will be the expenditure if in case that you're going to buy new one, and difference will be zero in this case. Now the depreciation here. So depreciation here for the new machine, definitely after a couple of years, means after 5 years. So depreciation, the value of this machine, that will also be depleted, that will also be deducted. So this is also one of the expenditure in case when we go for the buying new machine. So this is the expenditure. The difference will be, yes, the difference will be $95,000. So that will be the expenditure of the year or after 5 years. So now I'm just going to write here disposal disposal of machine. It means selling of machine. So which machine that you are going to sell? We're going to sell the old machine. So old machine here is, you can say disposable 20,000. So $20,000 that you are going to write here. That is not a negative, but we will get a profit out of it. Means some money will come. If we're going to buy the new one, definitely we will sell the old one. So 20,000, that will be the cash inflow. So cash inflow, the difference will be 20,000 once again. If we make a total of all these, then you will find that the total will be here for 325,000. And here the total will be 45 and difference will be 120. So what we need to write net income. So we will be having net income over the period of time when we are going to have new machinery. We're going to buy new machinery. So this is the correct analysis that we have done. There's another way to do this one. I'm just going to explain that one right now. So this is how we can do in a shortcut. So shortcut, like you can see the relevant cost. So relevant cost analysis. So what is that? So relevant cost analysis here is what are the relevant cost? Only the relevant cost that we are going to take. The first one is the saving that we have done. Saving in the variable expenditure. So saving in the variable expenses. So what are the saving that we have made? Definitely the 200. 200,000. 200,000 is the saving that we have made. And is there any other expenditure? Yes, so we have other expenses. So what kind of expenditure? The depreciation. Depreciation is the expenditure that we have to have for using of that machine in 5 years. So 95,000, that will be the depreciation. That is also relevant here. So what other relevant amount that will be? The disposal. Disposal of machines. By the disposal of machine, you will get something. So how much money that you're getting? $20,000. If we make a total of all these, then see the answer will exactly the same that we did here. So this will be the net income if we keep or if you buy the new machine. So what we have learned today, so we have learned that in case of the management want to take a decision in the managerial accounting. This is one of the very important factor and cost effective. So we learned like there is a differential costing and also there is a relevant costing.